So if you guys are just joining us, we're going to be answering some questions over from the Discord server as well as Patreon, kind of going over some stuff both with mortgages, housing, financing, some insights to real estate. Adam can introduce himself a little bit more, but he's an excellent guy to work with. I've actually done three mortgages with him now, so maybe fourth one on the horizon. So Adam, you want to talk a little bit? I mean, I guess it'd be good just to explain what a loan officer is and what they do.
Yeah, absolutely. Thanks for having me. It's actually four if you're counting the refi too. Three purchases.
That's true. So we're on to five, I guess.
I was telling my girlfriend, I was like, yeah, I mean, I do a mortgage for this guy every like 6 months, whatever he wants, he's got. But no, it's cool to be on here. Thanks for having me. But yeah, so loan officer essentially is the person that guides a buyer through the transaction on the financing side. So there's really two main people in a real estate transaction, whether you're buying as an investor, not going to live in the property, or your primary residence. It's the loan officer and the realtor. And there's going to be really hands-on throughout that process because it is stressful. There's a lot of paperwork. There's a lot of guidelines. There's a lot of bull that goes into buying a house. And my job is just to walk people through that process. It's what I do all day. I've helped over 400 people buy a house. So even if you're a seasoned investor who have bought real estate, 4 or 5 times in your life, my job is to make that a more streamlined process just because it's what I do all day. I've been through 400 plus real estate transactions. So I know what landmines can pop up and how to, evade them.
Yeah, there's definitely some landmines out there. And I think that also speaks to how, because a lot of people have, some of the questions kind of overlap with what I see like your whole realty team doing, where it's a collaboration between your realtor, the loan officer they're used to working with, the legal team they're used to working with. And if I guess, we'll talk more about financing, but I think on the buyer side, just making sure you're comfortable with whoever it is you're going to be working with, because these are the people that you kind of have to trust, especially kind of going into it not knowing. And I know when I was first introduced to you, Adam, obviously we didn't really know much about each other, and just like asking so many questions just to really understand what's going on. I think that's the big thing where it is kind of an intimidating process. There's massive amounts of money and numbers, and that's really the loan officer's job to kind of break it down to you. And you've always done a great job with that. So
yeah, for sure. I mean, like you said, you got to trust those people because there's really no barrier to entry for a loan officer or a realtor. So there's a ton of realtors and a ton of loan officers.
Yeah.
And you're putting hundreds of thousands of dollars in these people's hands. So if you can't like text your loan officer or call them on the weekend, same thing with your realtor, then you just have to reevaluate that relationship because like you said, it's so stressful that you need that hand-to-hand contact.
No, 100%. And God knows I've been there. I mean, one of the things when we put an offer in on the house that ended up being a fixer upper, I mean, that was something where literally I had the realtor go and check it out for me. I had Corey come and check it out, and then, called you on the weekend to say, hey, could we get an offer letter written up on this? So like the trust that Corey had looked at it, and that was good. But, it took a couple houses to get there for sure. So,
for sure. Yep.
I'm just going to pop up the Discord server here. So like this is live. So, I'll just let them know we are answering questions right now. Oh, I can't type while I'm in this. Oh yeah, we are answering questions now. So this has been great. I know I was trying to explain to you what Discord is, and it's basically like Slack. And I know you don't have Slack either, but also look at this spoiler. There it is.
Hey,
not there. But yeah, I mean, we have a little over 26 or 2,700 people here, but
it's crazy.
I think we can just go right down. So like one of the questions was, what percentage down do you need if you're owner occupied? And I think that gets into, they've heard 15 or 20%. If you could explain a little bit about like what the different levels of contribution are and kind of what comes with each.
Absolutely. So as a first-time home buyer, we'll talk about that specifically. I mean, if you go to Google and like ask that question, you're going to get 15 different answers. The answer is as little as 0 to 3%. I definitely don't recommend 0% down programs. The interest rate's higher. It's not as good as it seems, but it's out there. It's possible. But if you're a first-time home buyer, 3 to 5% is totally doable. I'm pretty sure on your first home, I think we did 3.5% down on an FHA loan. So it's a great option to leverage yourself, even if you're buying a single family or a multi-family. First-time home buyer, 3 to 5% down is totally normal.
Right. Now, in the advantages and disadvantages with putting more money down, obviously, is just kind of really knowing your math too, right? So for this person that's looking for owner occupied, You know, and I'll do a separate video aside from this about how I evaluate properties. But, you know, most people that are already paying rent, you already know how much you're contributing to that every month. You know, here in Providence, if you want to live in a decent part of town for a single bedroom, you $1,200, $1,300. Some of the luxury apartments, $1,800. So if you know what your cost of living is there is already, you know, a certain amount, what you get for rent can really help you with how much you want to put down. Because even if you do like you said, the 3% or 7.5%, you do pick up PMI on that. So which is something you explained to me perfectly. You know, just saying, hey, it's basically like insurance, because if you default on your loan, you got to pay a little bit extra because you're taking on, you know, more risk with everything. So to this first question, what percent down do you need? The answer is it really depends, but you know, and I'm curious what you think about this too. But I'm in the advice I got was you can only put down 3.5% one time. So that's if you're planning on having another property and you want to be able to kind of keep some cash together. To me, it makes most sense. But I mean, you do so many first-time home buyers. I'm curious what you see the most of.
So if you're a first-time home buyer versus a first-time investor, I have just two different approaches. So if you're a first-time investor, what you did was perfect. If you're looking to buy in a multifamily or multiple multifamilies down the line, you almost have to do 3.5% your first time, because you'd be crazy not to. It's your one chance to do it to where you don't have to spend all of your liquid assets for the down payment. And you still get a great rate. You know, is it going to cash flow the same as if you put 25% down? No. So there's that, you know, that unequal balance between, you know, the more money you put down, the less your monthly payment is. The less money you put down, the more your monthly payment is. But that first time putting down 3.5% is a huge advantage. When I bought my first multifamily, 3.5% down. That's the best way to go. If you're looking for a single family home, you might want to think about 5% down, 5 to 10% down, because there's no cash flow coming in from another unit. So you're just paying that monthly on your own. So having a little bit higher of a down payment for a single family probably makes sense, but you can still do 3.5% down on a single family too. So like you said, it just depends on your personal situation. But for a first time investor, 3.5% down, live in one side, rent out another, house hacking. It's the best thing. That's what I did. It's the best decision I've ever made. I mean, I'm sure you can say the same thing.
Oh yeah, no, 100%, 100%. It for me, it was just like kind of the two biggest things was one, not having to send that rent check to the apartment complex was such a great feeling. You know, and then two, to actually have, you know, I was moving like every year, a different apartment, different place. You know, the leases I lived somewhere for a year, the lease would change, my rent would go up, I'd move somewhere else. So just having like a home base and a place to call your own, super cool. And yeah, man, it was probably the best decision I ever made. I wish I'd done it earlier, to be honest.
Yeah, for sure.
Some questions were about protocol for approving loans. And I know you and I had talked about this because I sent you the article, and this was, someone asked this as well, I think around
Chase.
Yeah, Chase Bank improved, and you had answered that really good. So for those of you that don't know, Chase kind of tightened up their restrictions for lending. And Adam, if you could talk about what that means for other mortgage companies.
Yeah. So what Chase did was they basically changed their guidelines. So there are guidelines that the government sets in place for mortgages that basically say, all of you mortgage lenders, this is the bare minimum that you can lend on. And those guidelines are like credit score, debt to income ratio, down payment restrictions, things like that. So for example, you can get a mortgage if you have a 580 credit score. Technically, the government says that's the absolute lowest that you can get for a standard mortgage. Companies have the right to then put in overlays. And what overlays is extra risk that the bank isn't willing to lend on. So although the government says you can lend to 580, a specific bank doesn't have to follow those guidelines. They can put their own guidelines in place. So what Chase did was they said 20% down minimum and 700 credit score minimum once COVID hit, because a lot of people were losing their jobs, foreclosures went through the roof, forbearance went up astronomically. So they just didn't have the appetite to lend to more risky scenarios, which the risky scenarios are low credit score, low down payment. Not every bank follows those guidelines, thank God, because I mean, 90% of my business doesn't put down 20%, and very few people put down 20% on a house. Mm-hmm. So that was just Chase. So if you're getting a mortgage through Chase, that's their rules. The national rules are still in place. If If we had this a month ago, it would have been a much different conversation. It was a whirlwind. I mean, our guidelines, we're super lenient with that. We typically just go off of the government guidelines, but even us, we tightened up a lot. We went to 640 for a credit score minimum, and then we went to a 50% debt to income ratio limit when it used to be 56%, which is a big difference. That's a huge swing. But then we relaxed those guidelines. We went back to normal now that we are entering back into some form of normalcy in the market. But COVID really shook things up for a little bit. But for the most part, most banks are back to normal. Chase is an outlier. They don't have the risk tolerance, but mortgage companies like Movement and other companies that just do mortgages, we're back to normal for the most part.
Yeah, yeah, and that's a good point. Is that the banks make money in other places, so for something that's not a big money maker for them, they're going to try to mitigate their risk as much as possible because it's just not in their wheelhouse. Another question that's come up too is there's a lot of right now we're seeing kind of a situation where you'll have and this is a question that this Stevie asked, but you know, you might have a spouse where one of you is working right now and the other's collecting unemployment. Now you can't get a mortgage if you're unemployed. You won't get approved. Does anything change for spouses or?
Yeah. So I've had this situation happen a lot lately, right? Because unfortunately, unemployment's still at 14% or something ridiculous like that. So, I mean, I've been mid-transaction where one of the two lost their jobs, and that just shakes things up completely. Because, like you said, no job, no mortgage. It's pretty simple. It makes sense. It just doesn't work. But say you have two people on the loan. The spouse has a job, the other person doesn't at the time being. We can take off the person as long as the one source of income qualifies that person. We can take the person with no job off of the loan and put them on deed and title where they still have ownership in the property. So that's a big point of contention with spouses is they're like, well, I don't want to take my spouse off because then they won't have any ownership in the property. And what happens if I die? Then who does the house go to? If you put them on deed and title, they don't have to go on the mortgage and they still have the ownership in the property. It's still 50-50. So that's been a huge thing that people have been doing. If one person has a job and one person doesn't, qualify with one, and then the other goes on deed and title.
Perfect, man. Yeah, that's a really good point because I did not know how to answer that one. I had done a similar thing with my twin brother because he's collecting unemployment right now. I was trying to help him find a place down there, and I actually did not know. I was out of the mortgage loop. I think my mom helped out, but that totally makes sense with the cosign on it. So, next question's from Rob, and I know Rob pretty well. We've done a lot of business together, but he's been pre-approved for 20% down his price range. And his question is, again, should I put 20% down because I can, or is it worth keeping more money out of the property at times? And what impacts does that on the mortgage? So, I mean, we can just reiterate again, because these are the kind of questions that are repetitive, but you know, at 20%, what changes versus 3.5? And like, could you give us an idea? Like we talked about PMI before, but like percentage wise, you know, what are really the savings?
Yeah. So it is going to be a little bit less per month, but there's a little bit of a hack that I tell people if they're like on the fence of like 15% versus 20%, because when you go into a house, you do not want to spend all your money on the down payment because you're going to need furniture. If something comes up, you just don't want it to be house poor for sure. But the downside of not putting down 20% is mortgage insurance. So if you put down 15%, the mortgage insurance is going to be very little per month. It's probably going to be $50 a month, give or take. But so say you have a $300,000 house, right? 20% down of that is 60 grand. 15% of that is 45 grand, right? So that's a $15,000 difference for your down payment. But if you do 15% down, you have mortgage insurance, and some people don't want that per month. So the hack that I tell people to do all the time is what's called single pay mortgage insurance. So you can buy out your mortgage insurance premium where you don't pay for it monthly. You pay for it at closing at a discounted rate because you're paying for it up front. And it's usually anywhere from 2 to 4 grand, right? So your down payment's 45,000 and your single paid mortgage insurance is 4,000. That's 49 grand that you'd be spending. You still don't have mortgage insurance. You just saved yourself $11,000 by not having to put down the 20%, but still reaping the rewards of no mortgage insurance monthly. So a lot of people elect that option just because it saves them, you know, money over the long term.
Yeah, no, that's an awesome answer. And I'll relay that back to Rob. I'm sure they're going to see it live too. But you know, we also had some questions around refinancing. I mean, this guy's locked into a little over 3.5% on a 20-year note. Trying to kind of weigh the pros and cons of doing a 15-year note to kind of get down to 3%. This was something you and I had done. You know, his situation is a little different. The remaining loan amount on his $450,000 house is 196K. Whereas, you know, we had booked the house at, I think this was like 4.5, and then it dropped a whole point, maybe a year and a half after I'd bought. So it wasn't quite as drastic. What are, like, you know, how should they be evaluating that tool? Is that something like, I mean, I know the answer is a loan officer can help, but like,
Yeah.
where is refinancing most valuable?
So you want to do a cost benefit analysis. So that's the number one thing. So if you're going from a 30-year to a 30-year, like Tyler, when you did it, it made so much sense. You saved, I think it was $300 a month, give or take. And the cost to do it was like 2,500 or $3,000 or something like that out of pocket. So all you do is you take the monthly savings divided by the costs of doing the refinance, and then that'll give you that'll give you a month number. So that'll tell you how many months it will take to recoup the upfront cost. And if you're planning on staying in the house longer than it takes to repay the cost of it. So like, let's take that example, for example, right? Cost you $3,000 to refi. It saved you $300 a month. It's going to take you 10 months of savings to recoup that cost of refinance. You're going to be in the house for more than 10 months, which obviously you're going to be. Then every month after that, you're just saving $300 a month. It'd be crazy not to in that instance.
Right.
Going from a 20-year to a 15-year, and I would rerun the numbers to that guy too, because you probably have a lower interest rate by now. You have a huge equity position, perfect credit. You should be at like 2.875, 2.75. But that is going to be a more aggressive payment. So if his goal is to pay off his loan quicker, then he will succeed by doing that. If he's looking to just shave off a month to create more cash flow and lower his monthly payment, that's not going to be the route to take. You would just go into a 20-year at a lower rate, because 20 years are at like 3.25, 3.3. So it depends on what you're looking to do. But if you're just going from, 30-year to 30-year, 20-year to 20-year, take how much it costs to do the refinance, divided by the monthly savings. And if you're going to be there for more than the months that it takes to recoup the cost, then it makes sense.
Right. Well, and like you just said, that kind of gets back to the whole, with a lot of this stuff, the answer is it depends. But I think that really underlines the importance of whoever you're working with that really understands your situation. And they're not just saying, hey, rates are lower, you're trying to rush someone through on a commission or whatever it is. And you're kind of left as the home buyer, not quite sure what's gone on. So.
I've dissuaded so many people from refinancing, because obviously rates are in the news right now. So I've gotten tons of calls from people like, should I refinance? Should I do this? Should I do that? And I've told people, no, don't refinance. Probably more than probably not more, but I've said that multiple times because it just didn't make sense. It makes no one's a winner if you refinance and you don't save any money, or it's not a good process, because then that's a black spot on my name. And with loan officers, you want to get a local loan officer because reputation is everything, right? So like in Rhode Island, if I start doing refinances for people and they're not saving money and I'm costing them money and headaches, same thing with the purchase. If I blow up a purchase because I didn't do my due diligence up front, my reputation is going to be tarnished, and I'm all word of mouth. So I'm commissioned, right? So if I screw Tyler, I wouldn't be here right now talking to your followers and whatnot. Same thing goes with any loan officer anywhere. So you want to have a local loan officer who's going to have your back. Like that's the number one thing to look for in a loan officer, because reputation is everything. And if you start doing that, bad refinances, it's not good for business.
Yep. Well, I think that gets into, so Xavier's actually asking a question from being within the mortgage industry. I'm not sure if he's a loan officer or not, but he's asking what helped you grow so quickly, and what are some of the problems you face on a day-to-day, and how your team kind of helps you out.
Yeah, so there's two sides of being a loan officer. There's doing the loans, and then there's going to get more loans, right? So one side's lead generation, so getting more loans, and the other side is when you have a loan, not screwing it up. The most important part is being a master of your craft. Like you got to do the work to learn the guidelines so you don't screw anyone over. Because if you screw up a mortgage, that realtor will never send you another deal. That person that you couldn't close the loan for, they'll tell their friends never to use you. So the number one thing, if you're getting into the mortgage industry, is do not screw up loans. Like it's so much easier said than done, because you hear the horror stories. And like I said, there's no barrier to entry. So there's some bad loan officers. So if you're a loan officer, do the due diligence. Don't just hand out pre-approval letters like they're candy, and learn your craft. The other side is just hustle and grind. Like that's what you have to do. Meet as many people as you can. shake as many hands as you can, go to as many networking events as there are out there, just meet people and just come from contribution. Don't come from sales. Like, I hate being salesman. I'm not going to ask for the business or beg people to do loans with me. I'm just going to provide value, provide education. If they want to do a loan with me, great. They want to do it with their uncle's brother's cousin who's a loan officer, great. So that's the best piece of advice. Master your craft and then come from contribution, but lead generate the crap out of whatever area you're in.
Yep. No, I think that's awesome advice, almost for anything too.
For sure.
You can only kind of fool people so many times to really be successful. Like you said, your reputation's everything. It's got to be what follows you. And we had another question around kind of do's and don'ts in the mortgage. If I'm thinking about buying a home, should I be financing it? Should I be buying a car? Should I hold off on that? So what kind of things really hurt when you guys pull a credit score, and what are some things to avoid? If, let's say, I'm thinking about buying a house in December now, I'm starting to get ready. What should I be thinking about?
So the best piece of advice is start early. So go to a loan officer and say, I'm looking to buy in December. Where am I at right now? What can I do to be better for December? So that's the first thing. But if you're like in process or really close to starting the process, if the home is as important to you as it is for most people, which is the most important asset, put everything else on hold, like everything. No new credit cards, no furniture, no cars. Don't spend money. Save as much as you can. Work extra hours. Just treat it as if it's the most important thing, because for most people that it is. So things that people I've seen screw up is work less than 40 hours if they were trying to qualify off of 40 hours a week, spending their down payment money on furniture or something stupid that they don't really need. Opening up a new line of credit during the process is an absolute killer. We tell people till we're blue in the face, don't do this. You can only lead a camel to water. You can't make them drink. It still happens to people. So just put everything else from a financial standpoint on hold, because we will find it. Like, mortgages are no joke, especially after 2008. Like, we have separate in the back that I don't even deal with, like not background checks, but we know when you pull credit, right? So if you go out and get a furniture card or a new credit card, we're gonna find out about that. So just put everything on hold and be 100% truthful with your loan officer, because it's my job to help you get approved. It's not my job to deny your loan. I need to get you approved to get paid. So be 100% honest with me. Don't try to hide anything, because people lie to me, and I'm like, why do you lie to me? I could have helped you fix it, but now you lied to me, and now there's nothing we can do. You just screwed yourself. So that's the best piece of advice I got.
Yeah, so definitely be honest, and then I think, like you said, making sure that you're taking it as serious as you can is super, super important. We had a couple questions around COVID affecting hot markets, and it's been interesting because, again, the bad answer is regionally, from state to state, there's so many differences. One of my friends from Houston that does a lot of investing was saying, look at houses that are under 300K right now and what they're doing, and they're seeing a lot of competing bids at the lower priced homes. Now, you and I had talked about this because in Rhode Island and nationwide, listings are way down than what they're supposed to be, and you have to wonder, with supply so low, demand's also gone down, but the sentiment seems to be that supply's just gone down that much more than the demand, that we're just still kind of seeing. We're still seeing sales. What's been your takeaways in terms of a slowdown or ramp up with some of the COVID things now that we're about 2-3 months into?
Yeah, I have a super, I've been asked this question a ton. Like, what do you think the market's going to do? Where do you think home prices are going to go? And this is the response that's accurate, right? Every business, including real estate, is all based off of supply and demand. Prices are based off of supply and demand. And like you said, Rhode Island, for example, the metric is we're supposed to have 6 months inventory, which essentially means it would take, if no new houses hit the market, it would take 6 months for all of the houses to sell off of the market. That's a healthy market. Right now, we're at 2.3 months worth of inventory. So inventory is so incredibly low. And like you said, yes, buyers are also a little bit less, but not even close to inventory being as low as it is. So the demand is there from the buyers. The supply is not from the sellers, because there's nothing on the market. There's no inventory. There's only one way prices can go in that environment. With high demand and low supply, There's going to be competing bids. Like the guy asked, there's multiple offers. Every time a good house that's priced correctly, it's going to go over ask right now. So there's no way that home prices are going to come down. I had a couple buyers that are like, this is great. Like Corona is going to cause home prices to go down. No shot.
Yep.
If you look at, this is the super interesting statistic. Like this is the best nugget that I drop every time that someone asks me that. If you look at the last 5 recessions, because we're in a recession, you know, people don't like saying it, but we are. It's just the reality. 14% unemployment, it's astronomical. You look at the last 5 recessions and take out 2008 because that was caused by the housing market, right? We were the cause. Loan officers, realtors, appraisers were the reason that we entered into that recession in 2008. This is not caused by the housing market. This is a health crisis. It has nothing to do with real estate. So if you look at the 4 other recessions most closest to today, so the most recent 4 recessions, home prices on average increased by 4.5% during the recession periods. In the last 4 recessions, home prices increased by 4.5%. So this is not a housing crisis. Home prices are not going anywhere. And historically speaking, home prices do well in recessionary periods.
Yep. Well, and that's the thing I heard from so many people, and it's kind of tough because, right, like, well, first of all, millennials, whatever, we're like a huge, I mean, I'm 27, I guess I'm a millennial, but like, I remember the recession, obviously, and I think a lot of people, like you had said, they either don't want to really investigate why we had that recession. So I've been hearing from years from people that have been holding off buying a home as well. I'm waiting for the next recession. I think kind of thinking back to what that meant for them, because they've lived it, right? They assumed the next recession would be a housing shortage, and you know, that's just the thing that I haven't seen. And like, you know, we can speculate all we want. I think markets that, and this isn't Rhode Island, but some markets where they're heavily Airbnb, I think a lot of inventory is going to get freed up, at least for single family properties, where some of these guys are way underwater with some of the things that they made way too many risky projections. You know, to sustain a business on Airbnb, you know, they're going to have all that deferment up, you know, due at one time. That might alleviate some of these housing crisis problems.
That's the only market, like the second homes market, the vacation rentals is screwed. Like that market's really in trouble right now. But yeah, like you said, that's a really good point. That market's screwed.
Well, and then you know, this is going to be way later, but you have to wonder too, and it depends on so many things, right? Like if we can get a solid vaccination, you know, I hope that this will be similar to the flu, where it still needs to be taken seriously for people that are at risk to get vaccinated. We're far away from that. But let's say it's not. You know, a lot of these commercial buildings basically are worthless, and I think the government's going to have to come in and kind of incentivize commercially zoned places to kind of rezone and become you know, affordable housing. Whether or not that happens, I'm not sure, but that's definitely something that I'm looking at in terms of trying to make a decision long term.
That's a really good point. The 2 markets that, so I deal strictly residential, so I don't do commercial, but that is 100% accurate. Second homes and vacation homes, screwed. Commercial, screwed. Well, I mean, again, it's speculation. Things could change tomorrow, whatever. But my opinion is those 2 markets are in a lot of trouble. Residential areas like Rhode Island, you know, Massachusetts, Connecticut, they're going to be fine.
Yep. I have a question. We got a question on VA loans, which I think is related to the military. Do you have any info on that, or what that looks like?
Yeah. So VA loans, like, was they asking about VA loans?
Yeah, they said they recently moved back to Alaska. They're in the military and they want to buy, but they're nervous and afraid as a first-time buyer, and not really sure what the process is.
VA loans are the best loans by far. Like not even close. The best loan, it's the hardest to qualify for because obviously you have to serve your country. So if you can do it as a VA loan, without a doubt do it. 0% down, no mortgage insurance. Like that alone is like ridiculous. Like you don't have to put down anything and you don't get mortgage insurance and it's the lowest rates in the market. So if you're a veteran, it's a huge incentive is the VA loan. So for that guy out there, you know, again, talk to a loan officer, but VA loans are the best loans on the market, not even close.
There you go. Well, it makes sense too, especially if you're serving the country. We had another really specific question around someone that has a rental property that was hard money financed and looking to move it over to a traditional mortgage. I don't really know anything about that. You know, we've talked about hard money loans. I haven't personally looked into it, but what is that process like if you have an income property where you're trying to, finance it in a different way?
Yeah, it's pretty common. I've done a few of those where, they have a hard money loan at 12%, whatever it may be, and they just want to go into a 5% fixed mortgage just because it makes sense. So what you have to be really sure of is that they put a lien on the property. So typically they do, but there are some hard money lenders that are super sketchy and they just basically lend you money and say, pay me back. And there's no formal documentation, there's no lien. Because as a lender, I can only refinance if there's a lien on the property. And what a lien is just that loan. So it's a standard mortgage like I would write, or a traditional hard money loan if you do it from a reliable source. So if you have a 12% hard money loan and there's a lien on the property and you can produce some form of payoff, which basically shows the term of the loan and how much you have left, as long as you have enough equity in the property, which is 25% for a multifamily investment property, as long as you have 25% equity, I can do that refinance, no problem. The issues that we see arise is if we get it appraised and it doesn't have 25% equity, nothing I can do. And if they don't put a lien on the property, also nothing I can do. So just watch out for those two things and you should be fine.
Cool. We had another question around, I guess, career path for you. Coming out of college, was this like an end goal for you? Was this something you saw yourself as a junior or sophomore getting into? Like, what made this like click for you in terms of getting into this area?
Yeah, so I had no clue because you don't learn about this stuff in college. Mortgages, real estate, nothing. It's not a class that's taught. I was a finance major. I went to Roger Williams in Rhode Island, and my plan was to do something with stocks, go to Wall Street, live that pipe dream. Figured out that like picking stocks wasn't like a real job. Like there's no stock, brokers anymore, whatever. But I did know there's two things. I like numbers. I love Excel, math, all that stuff. But I also love public speaking and interpersonal stuff. I was in a pretty competitive finance program at Roger Williams, and we had different industries come talk to us. And one of the people that talked to us was a branch manager at a mortgage company, and just started talking about it. He basically said, if you like finance plus talking to people, this is the perfect job for you. And I was like, that's exactly what I want to do. But I had no idea about it. And it's like 5% finance, 95% people in therapy and sales, because like all I do is listen to people complain or freak out or are super nervous. So, but it's such a hidden industry in the finance world. I think more young people should get into it. The average age of a loan officer is 52. Yeah. 52 years old. And like someone asked like how you start out, like being young in the mortgage industry, huge advantage. I just got named the top 1% loan officer in the country, and it was 100% because I know how to transfer a document from Word to PDF. This industry is so old that younger people getting in have a tremendous advantage.
Yep. No, I totally agree. And that was how it started too, is I got a referral from one of our mutual friends.
Yeah.
From there, I was like, who do you recommend that's a realtor that's around our age that's good? And you linked me up with John and his team. And that's really been what's, I think, been empowering, is kind of working with people that get it, that aren't really worried about gatekeeping or whatever it is. And, I think that's super, super important.
My motto is just have a friend in the industry, right? Like that's how I try to, like, I consider us friends now. Like we can text and you ask me questions, I ask you questions. It's like, you just want to have that relationship. And I think a lot of people don't have that just because they go to like their parents' lender or something like that. But it's a huge advantage to have someone you can just text on the weekend and just be like, what are you
100%. I mean, and regardless of doing mortgages or not, I think what I try to encourage a lot of and I say kids, even though, adults, young adults, high schoolers, there's always have to be a gain for you to help, you know what I mean? So if you can put someone on or make a good connection, it doesn't have to immediately pay you back. It's just kind of part of, building your network and passing around leads and just referring business. That's, people wonder how, you can build connections, that sort of thing. And that's just such a great way to start, for sure.
Yeah, without a doubt.
But, we'll probably wrap up. We got, a lot of people right now, especially in this Discord, I'm assuming sole proprietor LLCs, they're making a decent amount of income, but, I know at least when I applied, right, I was technically self-employed as well through my, so as someone that is self-employed, uh, I remember the process looking a little different. I had to make sure that I showed you guys that I paid my taxes for that year. So what are some things for someone that's an LLC or self-employed to kind of like really be thinking about with the approval process?
Yeah, I'm really glad that you asked this question, because if a lot of people in this group are LLCs, they need to hear this, because this is the most important thing that I'll say tonight, without a doubt. So you did it perfect. You're super smart with your money. Like, because being self-employed, one of the huge benefits of being self-employed is you can write off everything and pay zero taxes. Like, it's a huge advantage that W-2 employees don't have, especially with the new tax laws that were in place this last year. But it's a huge advantage. You can write off everything. But the issue with mortgages is I can only use the money that you pay taxes on for approval. So if your gross sales were $100,000, but line 31 in your tax return, which is net income, or AGI, or whatever that type of income calls it, is 20 grand. In the eyes of the mortgage company, you make 20 grand, and you're not getting approved if you show 20 grand. So it sucks that you're going to have to pay taxes on the money that you make as a self-employed individual. But I can only use the money that you pay taxes on for qualifying purposes. There's some caveats to that. I can add back a little bit that you don't pay taxes on, but not a lot. So for 2 years, you do have to just kind of suck it up, pay taxes, and then you'll be fine and get approved. Like, you did it perfect, Tyler. Like, you made your money, you wrote off a good amount still, but you still showed a solid bottom line to where I could approve you, no problem. I could approve you for 3 houses, like, no problem.
And one of the things that, and this is getting off, like, for me, one of the things I found that was most important, because right, it sucked paying taxes. It sucks.
Yeah.
But if you're also thinking about saving for a house and you want to show more income, what really helped me was I was maxing out my retirement contributions. So I was still showing the taxable income, but still paying less taxes by contributing to my retirement fund. Now my cash in the retirement fund is not looked at by the mortgage companies in terms of reserve, but it's a way where you can do that. And then let's say worst case scenario, I can take the money out of my I have to pay, some penalties for it. But, if you're really in a bind about not paying taxes, there's a lot of creative ways where you can show income and still defer stuff.
Talk with your accountant and your loan officer. Like, having that relationship is super important, to where, like, you can go to your accountant and be like, hey, how do I write off taxes, but also meet the mortgage, necessities as well. And a good accountant will know the answer to that. Like you said, that's huge.
Yeah. Definitely consult an accountant. That'd be my best advice. I fooled myself thinking I could do stuff through TurboTax. Make friends with your local accountant. There's one literally right down the street I use. She's amazing. So yeah, guys. Well, listen, Adam, thanks so much for stopping in on this. I hope to God I recorded this the right way, and we can re-upload it. Otherwise, it's just going to be a funny conversation between you and I, kind of talk about stuff you already know. But yeah, man, would love to have you back. And there's a bunch of people that are local to the area that are trying to make some decisions. So I've passed your contact around to them and kind of explain a little bit what we talked about in terms of the level of seriousness that they want to have before starting that conversation. So yeah, man, thanks so much.
Absolutely. Feel free to drop my info to anybody. I'm always happy to help and just have the conversation. But thanks for having me. It's always good talking shop.
Awesome, man. Well, thanks so much. I'll talk to you soon, and let me try to figure out how to hang this up without fucking breaking it. All right, I got it.
You got it?
Yeah, later.
All right, man.